Right now, Bloom Energy is sitting on what might just be the single most lucrative backlog in the entire AI infrastructure boom. We're talking about a massive, unprecedented wave of hyperscaler demand driven by a global power crunch. But underneath this historic growth story, there is a hidden geopolitical supply bottleneck that could completely shatter the entire investment thesis. Today, we're looking at a company that holds the absolute perfect solution to the biggest problem in tech, but is simultaneously careening toward a wall that they may not be able to climb.
To really grasp the sheer scale of what's happening here, just look at this number, $20 billion. That is the size of the backlog and framework agreements Bloom Energy has amassed from giants like Oracle and Brookfield. These are hyperscalers desperately seeking off-grid power to fuel their next-generation AI factories. They literally cannot wait for traditional utilities to catch up. They need power yesterday.
But here is the central conflict of this entire stock. Oracle alone has an initiative scale for up to 2.8 gigawatts of power. Now, to build the servers necessary to supply that kind of gigawatt-scale electricity, Bloom requires a highly specific critical mineral. And right now, the entire global supply of that fuel cell-grade mineral is limited to just 30 to 40 metric tons annually. It's an astronomical demand colliding with a microscopic supply. Just think about that for a second. A $20 billion backlog bottlenecked by a pile of minerals you could fit inside a single shipping container.
So let's dive into the $20 billion AI engine. How does this business actually work, and why are tech giants essentially throwing billions of dollars at Bloom to solve their problems?
Well, Bloom's secret weapon is their proprietary solid oxide fuel cell, or SOFC for short. Basically, think of this like a localized microgrid you can drop right next to a data center. It bypasses the centralized power grid entirely, which means customers get their speed to power in under 90 days. But here is the real kicker for AI. Traditional generators produce alternating current, or AC. Bloom's solid oxide cells natively produce 800-volt direct current, or DC. That perfectly matches the required input for next-gen AI server racks like NVIDIA's Kyber. By completely eliminating the need for expensive rectifiers and step-down transformers, Bloom actually lowers the total cost of ownership for a data center by a massive 15%.
And honestly, the timing couldn't be better. McKinsey projects the U.S. IT data center power load is going to nearly double, jumping from 82 gigawatts in 2025 to 153 gigawatts by 2028. Centralized utility companies simply cannot build high-voltage transmission lines or baseload capacity fast enough to handle this surge. Connection wait times for large data centers are now stretching out between 5 and 7 years. If you're an AI company, you just can't wait 7 years. Bring your own power has shifted from a luxury backup option to an absolute business necessity.
The sheer volume of demand Bloom is pulling in is just unprecedented. We are talking about Oracle locking in up to 2.8 gigawatts and holding a $400 million stock warrant just to deepen their alignment. You have Brookfield Asset Management expanding a strategic framework to $25 billion to finance grid-independent AI factories. To meet all of this, Bloom is scrambling to scale its manufacturing to hit a 2-gigawatt annual run rate by the end of 2026. And by the way, if this kind of research-first analysis is your thing, you'll probably want to subscribe.
So why Bloom and not one of their competitors? Well, their economic moat is incredibly deep. First off, once those 800-volt DC busways are integrated into a data center, the switching costs become exceptionally high. Second, unlike PEM cells from struggling peers like fuel cell energy or plug power, Bloom doesn't use expensive precious metals like platinum. Instead, they use sand-based ceramic wafers coated with a proprietary ink. Third, they easily beat out legacy diesel providers like Caterpillar, because Bloom's non-combustion process actually complies with strict local emissions laws like California's Rule 21. And finally, their systems qualify for a massive 30% clean electricity investment tax credit under the Inflation Reduction Act.
But here's the thing. This brings us to the China supply bottleneck, because this is exactly where the mirage ends and reality sets in. For all those multi-gigawatt partnerships and tax advantages, there's a structural threat that could bring this entire operation to a grinding halt.
You see, Bloom's cells require a very specific critical mineral called scandium oxide. They use it as a trace dopant, which is essentially a critical chemical ingredient inside the ceramic to prevent cell aging and maintain high conductivity. The problem? To reach a 5-gigawatt annual run rate by 2030, Bloom would need approximately 220 tons of scandium oxide every single year. But currently, the total global production of fuel cell-grade scandium is only 30 to 40 metric tons annually. They are hurtling toward a mathematical impossibility unless something drastically changes. And guys, it gets worse. Over 50% of the global supply of fuel cell-grade scandium is refined in China.
In July of 2026, a short seller called Hunterbrook Capital released a report titled Bloom's Big Lie, accusing Bloom of secretly sourcing from Chinese refiners. This all came out right as the Chinese government added scandium to its restricted strategic materials list. Now, Bloom's management has publicly denied having a China supply chain, stating they have sufficient non-Chinese inventory. But the absolute lack of transparent, commercial-scale refining facilities outside of China leaves the market terrified of a geopolitical export squeeze.
Now, before we look at how the latest earnings are fighting against that fear, I want to mention that all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Portfolio Watch also monitors your portfolio and flags important changes, while Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
All right, let's look at the evidence in the numbers. What's really fascinating is how the actual financials stack up against all these supply chain fears. Let's dig into the hard evidence from Bloom's Q2 2026 earnings results, which were just announced on July 28, 2026. Do the numbers reflect the massive AI backlog or the impending supply bottleneck?
Well, they reflect the backlog in a massive way. Q2 2026 revenue surged 165.5% year-over-year to a record $1.065 billion. That completely crushed both the Zacks and Yahoo Finance consensus estimates by over 28%. This wasn't just a slight beat, folks. This was an absolute explosion of product revenue as they accelerated volume shipments for their key hyperscale partners.
And the profitability followed right along with it. GAAP gross margins expanded to 33.4%, with non-GAAP hitting 34.3%. But most importantly, the company actually swung to GAAP operating profitability, posting $182.2 million compared to a loss in the prior year. Their non-GAAP diluted earnings per share came in at 78 cents, beating Wall Street expectations of 41 cents by an incredible 90%. That is immense operating leverage.
Riding that incredible momentum, management actually raised their full-year 2026 guidance for the second consecutive quarter. They're now projecting a revenue midpoint of $4.05 billion, which translates to roughly 100% year-over-year growth. Unsurprisingly, this led to a massive 8% to 10% after-hour surge in the stock price. The market absolutely loved the near-term execution.
Which leads us to the qualitative scorecard. We really have to synthesize these massive financial beats with those underlying structural risks we talked about. That's where this scorecard comes in, weighing the health of the entire business across multiple dimensions, not just looking at the income statement.
So, the blended score sits at a 6.6 out of 10, and looking at the breakdown reveals the true dichotomy of this company. Market position and growth outlook? Stellar, 9 out of 10. They are the dominant force in an exploding AI energy market. But business viability sits at a dangerous 4 out of 10, entirely because of that Chinese scandium concentration. Financial health is a 5 out of 10, burdened by $2.47 billion in recourse debt on the balance sheet, and management alignment took a hit, scoring a 6 out of 10, largely due to $115.9 million in insider selling over the past 6 months.
So let's look at 3 future price scenarios. With shares currently trading around $184.89 and carrying a pretty lofty 82x price-to-earnings multiple, we really need a valuation framework to determine what the market is actually pricing in right now. Before we go through the model, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. And remember, you can get the full detailed model behind this at flash.stocksentinel.ai. Okay, let's break down the operational assumptions behind these targets for 2031. In our high case, Bloom successfully secures ex-US scandium supply, allowing them to execute flawlessly. Revenue scales past $18 billion, margins expand, and the market gives us an implied target of $353.
Our base case assumes standard execution but normal permitting delays. Margins stabilize at 15%, implying a 139 target, meaning the stock might actually be slightly overvalued today if things just go okay. And then the low case, which we've weighted the heaviest at 55%, models a severe Chinese export halt. Growth crashes, multiples get slashed, giving an implied target of just $21.
Now let's turn to the final risk assessment. That 55% probability on the low case might seem a bit aggressive to you, especially after a blowout quarter. But let's look concretely at the thesis-breaking risks that actually justify that caution.
These are the early warning signs you absolutely must watch. First, regulatory roadblocks are very real. Oracle's massive Project Jupiter build-out in New Mexico just had a critical natural gas pipeline permit denied by state regulators, potentially pushing commercial power delivery all the way out to 2029 or 2030. Second, execution flaws. Bloom's warranty accruals jumped to $77.8 million in Q2, up from just $20 million at the end of 2025. When you scale production this fast, product degradation and ceramic defects can completely devour your margins. Add to that a 4.7% share dilution in just 6 months, and of course, that looming scandium wall.
So let's synthesize all of this. Bloom Energy undeniably has the single best speed-to-power solution for the AI data center space. But having demand is only step one. They must convert these massive non-binding frameworks into actual cash flow. They have to protect their gross margins from warranty bleed, and above all, they have to navigate an incredibly treacherous, highly concentrated mineral supply chain.
Which brings us right back to our initial question. The $20 billion in AI demand is absolutely real. But if Bloom hits that 40-ton Chinese supply wall, this entire hypergrowth story shatters. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.